Thank you for joining Market News with Rodney Lake. This is a regular program for the GW Investment Institute, where we talk about timely market topics. I'm Rodney Lake, the director of the GW Investment Institute. Let's get started. Welcome back to Market News with Rodney Lake. I'm your host, Rodney Lake. On today's episode, we're coming to you from Foggy Bottom, the George Washington University School of Business, right here in the heart of Foggy Bottom, Duquesne Hall, Duquesne Family Studio. This is a production by the GW Investment Institute, educational entertainment purposes only. What are we going to talk about today? This is going to be a general overview, as we do in class when we kick off Market News with Rodney Lake. Today is the sort of closing in on mid-February here, 2/10/2026, when we're recording this. So it'll come out a few days after that. However, there's a lot of things going on that we're going to be talking about. And some of the things that I want to focus on here at the top of the show, the general market news, is the Mag 7. So last year, the Mag 7 really drove the market, and this year they are not. They are actually putting downward pressure on the market for some of the companies, and especially like Amazon, for example, when they announced earnings and had a fairly steep sell-off. Now, I'm going to give you my hot take on these companies and what I think is going on with these companies. So let's dive right in. So the Mag 7, for the uninitiated, you're talking Amazon, Alphabet, Meta, Microsoft, Tesla, Apple, and Nvidia. So that's the Mag 7, the Magnificent 7. And so what do I want to talk about first? Up first, I want to talk about the CapEx budgets. And so when you saw Amazon sell off after it announced earnings, and it did fairly well, but what was the sell-off from? Well, people, at least in the market and sort of what's happening, the reaction to is the CapEx budget for Amazon. So those who didn't see what the CapEx budget for Amazon was, they announced for 2026. This is not over the next 10 years, by the way. For 2026, this year, the CapEx budget is $200 billion. That is 1 year, $200 billion. Now, a lot of people view this as, over the target, what was estimated, and very concerned. And so you had a fairly steep sell-off in the company after it announced earnings and after it announced this very large CapEx budget, and even ahead of what people had expected, a very large CapEx budget in any case, but beyond that. So what's my take? The hot take for me here is you have companies that are now playing to win in the AI game. And I think you have to decide, not necessarily decide, but you have to do the work and then decide what is your take on this situation. And at least in my view, opinion here, remember, not investment advice, opinion here is that the companies that are playing to win, and not all of them, but these companies that are playing to win, and I'll mentioning Amazon first here, I think it's the right move. And why do I think it's the right move? Well, I think there's going to be winners and losers for sure in this game, like any other game. But the payoff here is quite significant. So if you think about even some of the productivity gains that maybe people are already getting now, just being more efficient, those productivity gains you can multiply by quite a lot. So the multiplication effect here is going to be quite high, for these companies that are at the center of this. Now, Amazon does not have their own frontier model. They are an investor in Anthropic and Claude, but they're supporting all of this. And so they have their Trainium chips, and they have a full Trainium data center that they launched not that long ago, which we talked about on a prior episode. But they are playing to win on the AI infrastructure, which is Amazon Web Services, AWS, AI chips, robotics, and the other piece, which we have mentioned before, is the Kuiper satellites. And so that, I think, is going to be super important, and I think we bring it back. Data centers in space. We talked about it on this show before. Lots of people in the market were talking about this. And if you listen to somebody like Elon Musk, who's running SpaceX and Tesla, they're talking about having data centers in space in 3 years and 36 months. And so, what's the reason for that? Well, if you think about the challenges for data centers right now, and so if you're here in DC and you drive out to Northern Virginia and you see all the big boxes that are data centers and one car parked outside, well, some people locally are not as excited to have maybe one job, and I'm exaggerating here a little bit for effect, but it doesn't produce a ton of jobs. It uses quite a lot of electricity and uses quite a bit of water as well. And so that's putting pressure in the not my backyard type of situation for building new data centers. And not that they don't have good economic output for some of these communities, but then you have to call into question, okay, well, what's the net impact? Do we think that we're going to get net plus benefits from this data center? And some people are saying that they're not sure. And so that's putting pressure on how to site these things and what communities to do it. And you have the Trump administration say, well, they have to figure out their own power setup for those data centers. So that's going to help in the short term. But longer term, and I don't even mean very long term, I mean the next 3 years, that pressure is probably going to get higher and higher with communities don't necessarily want these in their backyard, and the power is going to be another issue. So, what does that do? Well, it drives people to find other solutions. And so one of those solutions is data centers in space. And so how does that connect to Amazon? Well, the Kuiper satellites that they want to have up in space there, low Earth orbit, they're going to have their partner Blue Origin for launch, and hopefully they can get that launch cost down. So maybe they're going to be taking rides on SpaceX in any case in the short term, but I do think it's reasonable to consider that at the margin in 3 years that the pressure for the data centers will be in such a place, both on the power side, the siting, the water, that they're going to end up heading to space, and you got to get that launch cost down. But the pressure demand is going up for those resources here on the ground. But as they go into space, the sun shines. This gigantic fusion reactor in the sky called the sun is out all the time. There are no clouds. There's no atmosphere, and so you get much better power efficiency from the solar panels. You have to radiate the heat away from that, but possible as long as you're not facing the sun. And so there are absolutely ways to do it. Physics does say that it is possible. Now, the cost is the important piece. How can you do that at a lower cost? And again, I think that line is somewhere around 3 years. So Musk has put that out there, and that seems quite reasonable. 36 months to say the pressure for the earthbound data centers is going up with demand on new power. Because even if these places all, by the way, get the ability to build these power plants, you have to build them. And so where's that going to come from? So that's pressure on turbines. That's pressure on transformers. The joke is, you got to get transformers to get the transformers to work. And so that puts a lot of pressure on Earth here. And so I think that pressure is going to continue to mount, and that supply to demand imbalance is going to continue to grow, and that's going to push those marginal data centers, not marginal, let's say, those data centers to start being considered. Well, the economics are starting to play out where we need to get this in space. Launch cost is coming down. The reliability of the chips is going up. And there's already been some tests, by the way, for GPUs in space, Nvidia chips. And so that's already happening. So you got some early testing going on there, being resilient from the radiation. And so some of these problems are going to get solved more quickly than others. But let's say in 3 years, I think that's going to happen. So the Kuiper satellites for Amazon is a way to play that. So who else is in this mix? And so we're going to move on to a few other companies in the Mag 7. We're not maybe going to cover every single Mag 7 company today. Amazon had the biggest CapEx budget. Who is up next with the next largest CapEx budget in the Mag 7? That is Alphabet, also under some pressure. Now, Alphabet also playing to win, saying 175 to 185 billion for the CapEx budget. And they just announced that they're going to do this 100-year bond to help finance a lot of this build out. So that'll be interesting. I think that's worth watching. Investor, business person, analyst, you should definitely be watching what's going on there. Quite an interesting setup, 100-year bond from Google. And so here, when you talk about 175 to 185, again, playing to win. Now, what's the AI play for Google? Well, unlike Amazon, Google has their own frontier model, Gemini. And Gemini 3, as we've talked about on the show before, is quite good. So I think it's quite interesting to pay attention to that. So you have the other aspects of Google. You're talking Google Cloud, and they're building that. That's growing. You have the custom silicon and their TPUs, the tensor processing units on version 7, and they have been doing a good job for years on that. And now really just getting credit for that. And so they have the ability to sidestep, at least partially, the GPUs from Nvidia as an example. And because they have their own custom ASIC chips called TPUs, tensor processing units, to build their models, train their models, to run inference for Gemini 3. And again, Gemini 3.0, very good. We'll pause here and talk about, because they have a frontier model, the frontier models. This is another hot take here. The Amazon, again, does not have their own model. Alphabet has their own frontier model. So that's a big distinction between those two companies. Both are playing to win in a very different way. Now, maybe Amazon at some point will come up with their own frontier model. Currently, they don't have one. Alphabet does, Google. And so when you talk about this, it looks like also that these models, the ones that I think are the real frontier models. So who are the frontier models, at least in my mind? This is Gemini, this is Grok, this is ChatGPT, and this is Claude. Then you have a bunch, those are closed source. Then you have a bunch of open source, particularly Chinese models like DeepSeek, which was, put a lot of pressure last year on Nvidia. But I think this is going to continue to happen. The closed models seem to be ahead, let's say, on functionality and the ability to customize for clients. And so, but each of the models, when they come out, when you hear Claude Sonnet 4.6 come out, it leaves ahead of Gemini 3. And so Grok is doing very well in some of the benchmarks, for example. And so it looks like the models each continue to get better. Now, at some point, as an investor, business person, and analyst, you're asking yourself, well, is this becoming more commoditized? That's something that we have to think about and see, okay, what are the differences? If each version of the frontier model that comes out is just slightly better than the version of a model that came out just earlier than them, well, does that really have somebody move from one model to the next, or they're just going to continue to use all these models, especially if it's an enterprise setup? So, for example, that would have an advantage then for Alphabet to say, well, I'm using Gemini 3 and I use Google Workspace for all of my stuff. And so, yes, maybe the ChatGPT, newest model at the time, fast forward a year, 2 years from now, is slightly better. But I have all my stuff built into the Google Enterprise setup here, and I'm not really willing to change that for a model that's slightly better. Or the other thing is, people are going to continue to use all of the models and try to figure out a way to integrate them. So that puts pressure on pricing for different in different ways. And you can have somebody else come in. So we'll have to see how this plays out. I do think it's worth paying attention to. I do think if it becomes more commoditized, that gives, I think, an advantage to Google in this way, because it's an enterprise setup already, and a lot of people use it, businesses included, use it that way. And that's where Claude, that's not a publicly traded company, that's where Claude has really been focused, as opposed to ChatGPT, really been focused on the enterprise and the enterprise clients for that. So we'll have to see how that all plays out. All right, some other companies that I think worth mentioning before we run out of time in this show, but moving on to a few others. So Microsoft also announced big capex, over 100 billion. Could be closing on 150 billion, and that's Microsoft Azure. That is the cloud for the AI scaling. That is the Copilot, which if you've used Copilot, I didn't mention it as a frontier model earlier. I don't think that it is. I definitely think it is behind. But they're certainly in the AI game. They have a big investment in OpenAI and partnership, and so I think Microsoft is key to pay attention to. Also, again, big on the enterprise world. And so the cloud-based setup for Microsoft Azure, I think, is important, and obviously will continue to be important, or it obviously has been important. I think it'll continue to be important. Copilot, this is just something that I think Microsoft is going to have to figure out. And they're playing to win, too. So they're putting real CapEx dollars, and I think more than people expected also. And so that number is, I think, higher than what people expected it, and maybe higher than they're comfortable with. But I do think this is going to be a winners and losers game. And I definitely think that these companies, if you talk about Amazon, Alphabet, Microsoft, they are absolutely playing to win. And so we'll see how that plays out. Another Mag 7 here, which I think is in a very different situation. But let's talk about Apple. So if you look at Apple, they have pretty modest, let's say 20 billion or less in CapEx planned for 2026. That pales in comparison. That's not a small number overall, but that pales in comparison to what all these other companies are spending. And so even if you use the 20, Amazon's at 10x this year, and I don't think they're going to even hit 20. But let's say they're 20 to round it up. Amazon is a 10x. So those are two different leagues, an order of magnitude difference there between the CapEx budgets between Apple and Amazon. And this is where sometimes Apple gets the criticism that they don't have their own AI play in place. Now, Tim Cook has been out and saying that, well, we're the best position to deploy AI that our customers choose across our devices, the iPhone, and as an example, iPhone 17, which I have a new one, iPhone 17 Pro, and so I upgraded. And so, yes, the platform still is in the billions, and they have loyal customers, and people typically don't switch their phones. When I survey people in our classes and our students, and they say, and I say, hey, if we raise prices by 10%, who's switching to Android? No hands go up that are the iPhone users. And so it's fairly interesting. You definitely have that pricing power. You definitely have that networking effect. And so they're locked in. Now, maybe that thesis is going to play out for Apple, but it's a different thesis than the game that Amazon is playing. It's a different game than Alphabet is playing. It's a different game than obviously Microsoft is playing too. And so I think it's going to be interesting to see how this plays out. So services business did really well for Apple if you listen to the most recent earnings. And the iPhone 17 is doing much better. We've talked about that before than I think people anticipated. You definitely had the big upgrade cycle coming there. And Tim Cook is saying, hey, I do think we're best positioned to deploy AI against our network, our setup. Our customers are going to benefit from this, whatever this is. And so you saw them partner officially with Google, which will be the Gemini. And so that'll be interesting to see. And so, look, they're taking a different strategy. Now, it doesn't mean the strategy will work or it won't work. I do think it's interesting. And in some cases, you might have to say, look, if you didn't have a frontier model and you think you're that far behind, a different strategy is what you need to win. You certainly don't want to compete against competitors who are way ahead of you. And to replicate their setup probably means you just fall further behind them. And so we'll see how this goes. And that doesn't mean they won't launch something in the future, but it is interesting to see how that's playing out now. So another one here is Tesla. They're, let's say they're close to the $20 billion capex, and I think they're raising that to 60. They're going after, they're talking about building fabs to build their own chips, and really this AI 5 chip, AI 6, and all the things to follow are really the future, and that's autonomous driving, and that is the Cybercab as an example. And so we'll see, and power is a huge part of that. They're going to build a lot more solar. They have a factory up in Buffalo, New York, and they're going to be pumping out more panels. They just had a new version come out. So, and then they have the batteries that are grid scale and home scale as well. And so they're playing to win also. And so it will be interesting. They're playing in a different part. That's, the real world AI, which is, how do you get a car to move around, with a passenger in it without, having them have to drive, or at least right now you're basically have an assistant with full self-driving. But they're very close to solving that if it's not solved already. And so it's going to be interesting to see how that plays out. That is real world AI application. They're still spending a significant amount of money, not quite as much as the others, but you're deploying big dollars. They have been efficient in the past, and I definitely think that they're the leaders in autonomous driving. Waymo is part of Alphabet, or is majority owned by Alphabet, so we'll see how that plays out. Next up, we can't close the episode without talking about Nvidia here. So before I mention Nvidia, we'll just quickly talk about Meta. So Meta is spending, 135 billion, for example, plus, and they're focused on wearables. And Llama is their open weight, not fully open source, open weight model. There are some limitations when you get to a certain point, but they're absolutely playing to win, and playing to win, obviously, in the advertising. They are building out their AI ecosystem, and they have these wearables, the Ray-Bans, if anybody's seen them or used them, and have the commercials if you've seen them. Meta, tell me this. So I think that's interesting. I think they're in a slightly different game, but they're playing to win in the AI game for sure, with big CapEx dollars being put to work. And so, again, before we close here, let's talk about Nvidia. So Nvidia is going to continue to spend, and Nvidia, it keeps coming out with the next version of the chips. And I think different than the other AI companies or AI plays in the Mag 7 here, are the ways that these Mag 7 companies are playing AI. What's Nvidia? Nvidia is the purest technology company. So if you hear Jensen Huang, the CEO of Nvidia, talk about Nvidia, it's a very different setup, right? So the other companies make their money differently. If you pick all of these companies, each one of them makes money in a different way, and some are similar. Nvidia is probably the purest play tech company specifically. They really sell technology to their customers, leading edge technology in the form of GPUs. And you hear Jensen talk about this, that they're selling leading edge technology that are inputs to their customers. And they really don't then, in a way, compete with their customers. And not sometimes they are competing with their customers, but not always. But they're really selling technology. So I think that's an interesting setup. And I think that's something worth thinking about their business model. So they're really the purest play technology company in this group. And when you think about CUDA, the network they've built around that, that's the software wrapper here that we're talking about, they continue to spend a lot of money. Vera Rubin coming out, even more powerful than Blackwell, and they keep making the chips more and more powerful. And so if you think about, even if you have your own TPUs, like Google as an example, or the Trainium chips at Amazon, you're probably going to want to continue purchasing these Nvidia chips as it seems like compute is just going in one direction, which is up, or demand for compute is just going one direction up, which positions Nvidia well. Now, people can displace it. You have all these other things, which maybe they still want the chips, but the pricing gets downward pressure. That hasn't happened yet. So we're going to be paying close attention to this. Nvidia for the Investment Institute and our students is a big position in our portfolios. And so we're going to keep a close eye on what's happening at Nvidia. But again, different than the other AI plays here, that's a more pure technology play than I think all the rest. Now, their network can be eroded like anyone else, but they continue to invest heavily. The cadence once a year coming out doesn't seem to be slowing down. And Jensen Huang has 40 direct reports as the CEO, co-founder. He does not seem to be slowing down as an investor. We really like that. So founder-led businesses that are working super hard, we appreciate. So that's the Mag 7. That's this episode for Market News with Rodney Lake. We look forward to seeing you on the next episode. Thank you. See you next time. Disclaimer, the content shared in the GW Investment Institute podcast is for informational and educational purposes only and should not be considered investment advice. The opinions expressed in this podcast are those of the host and guest and do not necessarily reflect the views of the GW Investment Institute or the George Washington University. Listeners should not act upon the information provided without seeking professional advice from a qualified financial advisor. Investing involves risks, including the loss of principal. The GW Investment Institute, the George Washington University, and the podcast hosts do not assume any responsibility for any investment decisions made based on the content of this podcast. Always conduct your own research and consult with a financial advisor before making any investment decisions.